Let's take a look at Nvidia stock today, as we have an upcoming earnings report. We'll explore whether we can surpass historical highs, review market forecasts for the company, examine historical volatility, and most importantly, analyze support and resistance levels, specifically the trading volumes and options. We'll try to figure out what lies ahead after the report. Let's start from the beginning. As we can see, Nvidia recently dropped by 33%. That's quite significant. Minus 33% is a lot. Naturally, after such a sharp decline, Nvidia has rebounded and grown by 40%, nearly returning to its historical highs, and the earnings report is just around the corner. This report could serve as a catalyst for either a sharp rise or a sharp drop in Nvidia stock. Let's take a look at volatility, starting with the volatility smile. We can see that volatility is very high, especially for the near-term expiration dates, reaching nearly 100%. Just think about it, volatility for the upcoming week is 100%, which is incredible for a company that is among the largest by market capitalization in the world. We also observe that the volatility is skewed towards put options, indicating a bias towards a potential drop in the stock. Investors and traders are pricing in the possibility of negative scenarios for the stock, but they are also hedging by purchasing put options. After buying the stock, they hedge by using put options. As a result, put options are usually more expensive than call options. This is a normal situation. Now let's look at historical and implied volatility. As we can see, the historical volatility is the gray line, and the white line is the implied volatility. Currently, the implied volatility for the next week is at 90%, which is of course partly due to the upcoming earnings report. If we exclude such events, the volatilities are roughly equal and at the same level. Why am I showing this to you? I always remind you that you can trade not only the underlying asset, but also the volatility. How do you trade volatility? I can show you. We could say that volatility will drop by 15%, and artificial intelligence would analyze and suggest interesting strategies. Let me show you one of these. We are suggested to sell call and put options with strikes of 130 for October and buy call and put options with strikes of 130 for November. This is a volatility reduction strategy. It's quite complex and requires careful management as it involves different expiration dates. I'm just demonstrating what's possible here. Naturally, I wouldn't recommend opening this strategy without proper consideration. Now, let's focus on the most important aspect, the trading volume of options. As we can see, the largest volume is concentrated around the $130 level. Currently, we have been unable to break through this level for several weeks. We've been trying, but so far nothing has worked. Again, this is related to the massive volume of call options. Let me quickly explain how market makers operate and why it's crucial to monitor these volumes. When someone buys a call option, the market maker sells that call option. To sell the call option without losing money, the market maker hedges by buying the underlying asset according to the delta. This is known as delta neutral hedging. Since market makers have sold a large number of call options, especially at the $130 strike price, they would prefer that the price does not go above this level. But it's not just the market makers, other market participants who have sold options also want to keep the premium for themselves. That's why we see such large volumes here, and it's essential to keep an eye on them. The next significant volume level is at $128. In fact, today we're trying to break through it, but so far it's not going very well. We'll see how the stock closes, whether Nvidia stock closes above or below $128. The volume of put options is not as large, while call options have volumes reaching 430,000 contracts. Put options max out at just 170,000. So we see an uneven distribution. Again, many are buying call options, as we see that the volumes are heavily skewed towards call options. This suggests that investors, traders, and other market participants are betting on the stock rising. They believe the stock could go up, possibly as a result of the earnings report, and might even rise to $140 or $150, breaking through the current consolidation. Is this possible? It very well could be, but it's crucial to keep an eye on such large volumes. I also remind you that the green color represents options that expire today, August 23rd. Naturally, all these options will roll over into next week, and the volumes may change. This is something to keep in mind. Now let's talk about the market forecast. What does the market think about Nvidia stock? I remind you that all information about options and derivatives is concentrated here. Let's take a look at September. The market is pricing Nvidia stock at $120 to $125 in September. So there may not be significant changes expected. Again, this is partly related to the upcoming earnings report. The market hasn't fully factored in the report yet. Once the report is out, it will be clearer what lies ahead. Looking at October, the market is already pricing in a slight decline. with expectations around $120 to $124. The market is forecasting a gradual decline in Nvidia stock. If we look at the end of the year, the market continues to price in a decline. I suspect this is also related to an impending recession, which may start at the end of this year or early next year. Sooner or later, it's likely to happen. I believe Nvidia's stock could fall significantly as a result. Now, let's focus on the chart itself. What's happening here? I want to remind you of my philosophy. I don't claim to know where a stock will go, and I don't try to predict price movements. My primary focus is on effective position management. The goal is to construct a position in such a way that, regardless of where the stock moves, we can profit. And again, considering the mathematical expectation and the potential risk-reward ratio, this isn't the best point to buy. The stock is currently at its historical highs, and the risk-reward potential is not in the investor's favor. Yes, the stock could rise to $140 to $150, but there's also significant downside potential. So I wouldn't recommend buying the stock outright at this point. But how do we play this scenario? I'll show you a strategy I've developed, but first, let's look at 3D volatility. This provides all the information about volatility, the derivatives market, and options. Professionals often use this to build their positions. Now, let me show you one of the strategies you could consider. The profit profile for this strategy looks like this. If the stock rises to $160, we could make $14,000, $15,000. If it drops to $105, we could make $9,000. And if the stock stays within any of these ranges, we'll still make money. So think about it: whether the stock falls or rises, we'll be in a position to profit. This is exactly what I mean by effective position management. The idea is to construct your position so that you can profit regardless of the stock's direction. The options strategy looks like this, but I'm not recommending opening it casually. I'm showing it for demonstration purposes only. This strategy is complex, and I wouldn't recommend anyone open it without careful consideration, because if the stock suddenly starts to drop or rise sharply, you could lose money. This position requires active management. You need to buy, add to, or sell options continuously. Simply opening a position and waiting won't work. Now, let's return to Nvidia stock and what might happen. Without a doubt, before a recession hits and the markets begin to decline significantly, Nvidia stock could still rise possibly to $150 or even higher. However, if I miss out on those $20 per share, it won't bother me at all, because I understand that the company is overpriced and its valuations are irrelevant. Yes, some might argue about Nvidia's prospects, but let's look at what happened to Intel's stock. Intel was also considered a highly promising company, one of the most promising in the world, in the year 2000. As we can see, since 2000, Intel stock has still not reached its all-time high, and today it's trading 75% below that level, even after 25 years. Although Intel was seen as very promising back then, the same could happen to Nvidia's stock. During a recession, I wouldn't be surprised if Nvidia's stock falls to at least $50, and if things go badly, it could drop to $30. Yes, this forecast might sound absurd right now, given that the stock is at its historical highs. But I would strongly advise against risking everything and investing all your money in one company, because sooner or later, you could suffer serious losses. I never recommend investing more than 10% of your portfolio in a single company, as it's highly risky. If you have any questions, feel free to ask in the comments. Also, I suggest watching my previous video on Alibaba, where I shared many insights